country-by-country basis as a part of his current job. So once again, a very good morning, welcome, and over to Mr. Andrews Thomas. Once again, friends, a big round of applause to take us for the next session, Mr. Andrews Thomas. Mr. Thomas, please.
Thank you very much. As my title is Demanding Times for Zinc, I'm going to start my paper off by talking about Wood Mackenzie's global economic outlook. I'll then narrow my focus to discuss our views on the Indian economy, its steel market, and its zinc market. After that, I'm going to step back and look at the global zinc market and discuss some of the key structural issues that it faces over the next couple of years. And finally, I'm going to conclude with what we think the zinc price is going to do over the next 5 years or so. So after a weak 2013, the good news is that the 2014 is shaping up to be a good year. Wood Mackenzie is forecasting that the global economy will grow by 2.7% this year. That's up from 2.1% last year. Growth is going to be primarily driven by the recovery in the developed economies. And for the first time since 2010, 3 of the world's biggest economies, the US, Europe, and Japan, will all grow together. This is going to boost global trade, particularly for emerging markets. But the outlook for the emerging markets is a bit more mixed. We've recently downgraded our forecasts for Russia because of the political crisis that it's having with the Ukraine. And in Brazil, despite hosting this year's World Cup and the forthcoming Olympics, it's battling with high inflation and underinvestment. On a more positive note, in Asia, we expect that the export-led economies of China and South Korea, and to a certain extent India, will all benefit from higher export growth as the global economy recovers. But in the medium to long term, however, the main driving force behind global growth will be the US and China. This chart on the left shows that Asia as a whole has posted some impressive gains since the 2009 downturn. For example, China and India's GDP is forecast to grow by 50% by the end of next year from the lows of 2009. In contrast, Europe has barely grown at all. However, the US remains the leader of the pack, and it is the first country to recover to pre-crisis levels of output. Looking at the contribution to global GDP growth over the medium term, you can see that both the US and China, the light and dark blue lines on this chart, are going to account for approximately 50% of GDP growth. In the longer term, the story holds true, with China and the US being the primary drivers of GDP expansion over the next 2 decades or so. But it's important to note that India, at 7%, is going to make an increasingly important contribution to the global economy. So now for India. It's experienced a tough couple of years. High inflation and the resultant high interest rates have constrained both investment and consumer spending. But the country's fortunes seem to have turned a corner with the election this year of its first majority government since 1984. We expect that this majority government will now be able to take a more decisive role and pro-business role in its policy making going forward. We've already seen an improvement in Indian business sentiment, and we've seen investors putting money back into India's equity markets. But the government faces a huge challenge in reforming the Indian economy, and from a metals perspective, a key area of concern is the chronic deficit in infrastructure. Excess red tape and poor governance over the last 2 decades almost has resulted in capital investment in infrastructure and what have you stalling. In fact, gross fixed capital formation, a measure of spending on things such as roads, machinery, and other capital goods, has effectively flatlined since the beginning of 2011. Now, taking a longer-term view, Wood Mackenzie forecasts global countries' GDP based on 3 key supply-side factors. The first is labor input growth, the second is capital input growth, and finally, productivity growth. So these are the 3 key ingredients that drive economic growth. They're very similar to the drivers behind a company's growth. A company needs its workers, it needs its machinery, and it needs these things to work together efficiently. So when we look at the populations of India and China, we can see two contrasting pictures. Although the total population is roughly the same, the composition is very different. The Chinese working age population, that is people aged between 15 and 64, is set to peak in 2016, and thereafter it's going to decline to around 950 million by 2035. India's working population, however, is going to rapidly expand over this period, increasing by around 200 million people. But our view is that it's not so much about the number of people in an economy, it's what they actually do. And there's a few points to be made about this chart. Firstly, you need to look at overall employment. In China, more than 50% of the population is in the formal workforce, whereas in India, this number is around 30%. The main reason for this is the low level of female participation in the Indian labour market, and the fact that a lot of workers are involved in the informal agricultural sector and so aren't accounted for. As a result of this, by 2035, India's actual formal working population will be 60% of that of China's, despite having a bigger population. The next important point is what sort of jobs are these workers doing? In China, we expect to see a major reallocation of workers from the agricultural sector into the service sectors and into manufacturing. This will help boost productivity growth, as productivity for the labour in manufacturing and the service sector is typically 4 to 7 times that of the agricultural sector. So if a farm worker earns $1, a worker in a car factory or a restaurant will earn $4 to $7. But in India, we forecast that the majority of workers will remain in agriculture. And this is because of the slower rate of urbanization and the lack of skills to meet the job requirements of urban jobs. So I've looked at the population and labour drivers. What about the capital? Capital stock refers to your physical assets, like roads, buildings, and machinery. Now, this chart shows the size of a country's capital stock after it's been adjusted for the size of the population. As you can see, India and China are still at very early stages of their development when compared with their more mature economies. But the right conditions have to be present in order for investment growth to take place. Again, we can see two different stories here. In 1990, the urban population of China and India was at a very similar level. But since then, we've seen a huge widening of the gap between the two. And by 2035, China's going to have more than 400 million people more living in its cities than India will. So the ratio urban residents to rural residents in China is going to be around 70%, but in India, it will be just 44%. But despite these issues, we are very optimistic for the long-term prospects for the Indian economy. We expect that GDP growth will be sustained in the region of 6 to 7% per annum, and productivity will improve as investment in both human and physical capital grows and reaps rewards. Investment growth will also be supported by improving capital markets. If you look at the red and green lines on this chart, you can see that the profile for India's growth is different from China. This is because India is starting from a much lower base, and we do not expect to see its economy decelerate over the forecast period the way we expect China's to. So how will India catch up in GDP per capita terms? Well, China's GDP per capita is forecast to triple by 2035 to about $13,000 per person. But in India, because it's lagged behind because of the slower pace of urbanization and the slower pace of job creation, we don't expect it to reach these sort of levels, but rather match China's current levels today. So what does this mean for zinc? Well, in India, and as Steve has just mentioned, the world in general, galvanizing is the dominant first-use sector for zinc, accounting for approximately 60% of global demand. In India, I suspect this figure is probably higher, probably closer to 70%. Galvanizing is in turn driven by capital investment in the construction and infrastructure sectors. So before I focus purely on zinc, I'm going to talk about the views that my colleagues in the Wood Mackenzie Steel Metal Market Service have on India. They describe India as a land of mystery. This is not because of their overactive imagination, but because there is considerable uncertainty surrounding the timing and impact that economic reforms will have on steel demand. Because of this, they have taken quite a conservative view of Indian steel demand and are forecasting average annual growth of around 4% per annum in the near term. But in the long term, they are certain that we are going to see a surge in Indian steel consumption. In this chart, per capita consumption for India is represented as the dark blue circles, and in 2013, this amounted to 55 kilograms per person. But by 2035, we forecast that it will reach 155 kilograms per person. But as you can see from the other colors of this map, it will remain well below the per capita consumption seen in other emerging market countries and a number of developing world countries. For us, the big question is how will this, but in tonnage terms, this equates to a 160 million ton increase in Indian zinc steel consumption over the next 2 decades. So the big question is how will this demand for steel be met? Or simply put, where will it come from? Well, there's a number of options. The first one is India moves to produce the steel domestically, and then it develops the infrastructure to produce the iron ore that it will require. Option 2 is India produces the steel domestically, and then it imports the iron ore, becoming a major player in the seaborne iron ore trade. And finally, India could just import the steel it needs from other countries. Well, we think option 1 is the most likely. And we forecast that Indian crude steel production will rise to over 230 million tons by 2035. This is an average growth rate of just over 5% per annum. And certainly, the currently announced or rumored steel capacity expansion plans by SAIL, Tata, and other Indian steel companies certainly support this view. So now to zinc. India is a truly global player in the world zinc market. Thanks to Hindustan Zinc, it is host to the world's 2nd largest zinc miner. It's also the host of the world's 3rd largest zinc smelting company. And with Rampura Agucha, it has the world's biggest zinc mine, which is 20% larger than Red Dog, its nearest rival. As a result, as a country, India is the world's 4th largest producer of mined zinc, is the 3rd largest producer of refined zinc, and thanks to the efforts of you gentlemen and your colleagues over the rest of India, you're the 3rd largest consumer of refined zinc. Unusually, India is almost self-sufficient in meeting its raw material needs for its zinc smelting industry, and at least on paper, it's also self-sufficient in producing enough metal for its consumers. However, towards the end of this decade, this is going to change, as we expect that global Indian consumption will start to outstrip domestic production. And as a result, India's zinc producers will either have to increase production or its consumers are going to have to increase the level of imports. But in fact, I suspect we'll have a little bit of both. As I've already said, in the coming years, we expect to see a pickup in capital investment in India from both the government and the private sector. This pickup in capital investment will, we believe, boost zinc demand from India's galvanizers, who will in the coming years see good growth in demand for their services and products. However, capital investment will take time to have an impact, and in 2014 we forecast that India's appetite for zinc will grow by just 3%. And it's not going to be until the latter part of this decade that we expect to see growth accelerate to around 7% per annum. So what does this mean in per capita terms? Well, back in 2000, you can see that the world was clearly polarized, with the world's developing or developed economies having per capita zinc consumption in the order of 5 kilograms per person, and the world's emerging markets less than a kilogram. However, in the intervening period, we've seen China take off, and its per capita zinc consumption has rapidly increased towards the 4 kilogram level. and the importance of the developed economies and the other emerging markets has shrunk. Nevertheless, by 2020, India will be starting to approach the 1 kilogram per person level, and it will still be the third largest zinc consumer in the world. So globally, the story is going to be very similar. Urbanization and industrialization in the developing world and the resultant demand for galvanized steel by the construction sector is going to be the primary force behind global zinc consumption growth. But in the longer term, we also expect that the automotive sector, particularly in countries such as China, is going to play a more important role as domestic car companies move to increase their use of galvanized sheet in order to compete with foreign-owned companies. As a result of these trends, we forecast that developing world zinc consumption will grow by around 4.5% per annum in the long term. But in the world's mature economies, they're going to flatline at best and may well decline. So in global terms, zinc consumption is going to grow by an average rate of around 3.5%. In tonnage terms, this equates to between 600 and 700,000 tons a year of new zinc demand. Such an increase is going to cause problems for the world's zinc producers. Firstly, in terms of metal production. Based on our analysis, we expect that global demand for zinc metal will outstrip smelter production capability in about 2 years' time. In order to meet the demand for metal in subsequent years, the world's zinc smelting companies are going to have to increase output by either expanding their existing operations or building new smelters. And certainly our analysis suggests that there are enough advanced stage smelting projects out there to push this bottleneck in supply back towards the end of the decade. But as consumers, I wouldn't worry too much about smelting capacity. As long as the demand for metal is there, smelters can be built relatively quickly. In China, the construction process can be as short as 18 months, whereas outside of China, a construction time of around 3 years is achievable. Increased demand for raw materials, and the outlook for zinc mining is altogether different. Firstly, zinc mines have finite lives, and unless an exploration geologist can find an extension to an ore body nearby a mine, the mine is going to close at some point. Unfortunately, today, we are living at a time when several of the world's largest zinc mines have or are about to close. Last year, we saw the Brunswick mine shut and the Perseverance mine shut as well. Next year, the giant Century mine and Lachine mine is going to close. And then in 2016, the Scorpion mine and potentially its smelter is also going to shut. And then by 2017, we're going to see another major mine close in Poland and another one in Canada. So not only is the global zinc mining industry going to have to increase production to match the growth in demand, it's also going to have to increase production to offset the closure of these major mines. This is going to be a major challenge for the global mining sector. Now, some of the growth and the gap will be filled by mine life extensions. This exploration process I mentioned earlier will help a little. But what the world is going to need, and needs soon, is the construction of a number of new zinc mines. Now, we track all the zinc mining projects that we can find, and our analysis of the 35 most advanced zinc mine projects in the world suggests that by the end of this decade, they could be delivering as much as 2 million tons a year of new mine capacity. The remaining gap, we think, could be filled by the Chinese small-scale mining sector. But there is an issue with this assumption. Earlier in the year, myself and my colleagues looked at every single one of these advanced stage mining projects outside of China. We looked at factors such as their geology, their size, their location, who owned them, and whether they required significant amounts of infrastructure. We then scored them on these criteria to produce a ranking. Now, on this chart is the result of the ranking. Along the bottom, you can see the amount of money that will need to be invested to develop this almost 2 million tons of new mine capacity. But the problem is, at today's zinc prices, we don't think investors are going to put their money into these new mine projects. And the risk is growing that if we do not see these mine projects and their owners raising significant amounts of money very soon, there's going to be delays in the development of these new mines. So what does this mean for the zinc market? Well, we think that the balance of the zinc market is changing. Historically, the world has tended to produce more zinc than it is needed and has tended towards surplus. As a result, you consumers have enjoyed fairly high stocks and reasonably low prices. Going forward, and especially over the next few years, we're forecasting a switch. We expect that the position will be reversed and the zinc market will in future tend towards deficit. So what does this mean? Well, when we've had deficits in the past, global inventories of refined zinc have been drawn down. And when these stocks are drawn down, as we saw in the period 2004 to 2007, zinc prices have climbed to very high levels. And this is exactly what we expect to happen over the next 5 years or so. In fact, when we think zinc stocks fall to levels of around 40 days of global zinc consumption in 2017 and 2018, we would expect the zinc price to rise at least to the level of the 2006 peak, so around $4,000 a ton. But as a forecaster, I've got to cover myself, and there's lots of risks and uncertainties surrounding the zinc market. On this chart, there's a number that could push prices higher and a number that could push prices lower. But today I'm going to focus on just the two most important. And first, as you might guess, is the timely development of new mines. We need to start seeing mine construction getting underway, not in 5 years' time, but in 1 year's time. We haven't seen it yet, and if it doesn't happen, we're going to see a much more rapid drawdown in global inventories of metal, and we are likely to see the price move higher much sooner than our base case forecast. Now, the other big risk and uncertainty is China, and its smelting industry in particular. Now, historically, Chinese smelters have tended to produce much more metal than the Chinese market has needed and much more metal than the world has needed. And for much of the 1990s and the last decade, this depressed zinc prices and kept stocks high. And this could happen again in the future, theoretically. But in 2011, something very strange happened in the Chinese smelting industry. Despite having a good zinc price, a reasonable TC, good supplies of raw material and good demand, Chinese smelter production barely grew. Furthermore, in 2012, Chinese smelters actually cut output. Now, this was a game changer for us. It's the first cut to Chinese refined production for over 20 years. So why did they do it? Well, we think it was down to profitability. You've seen such a rush of expansions in China over the last decade, and such competition for concentrates. Chinese smelters were no longer able to operate profitably, and, surprise, surprise, they started acting rationally. Now, in 2013, we saw a bit of a rebound in output. It grew by 8%. This year, our base case forecast is that Chinese refined production will grow by around 6.5%, and then by 10% next year, and another 10% the year after. But we think profitability is still a major issue for many Chinese smelters. And this belief was confirmed when I visited China in May and spoke to a number of them. And they all told me that they are losing money at today's zinc prices. And this is the reason why I think for the year to date, Chinese smelter production has grown by just 2%. So this is clearly a risk. If Chinese smelters do not grow production in line with our base case forecasts, the risk will grow that inventories, both in China and elsewhere in the world, will be drawn down much more quickly. And as a result, prices will move much higher. So, to conclude, going forward, the world's galvanizers will be the primary driving force behind global zinc demand growth. However, this robust growth is going to create a very near-term problem for the world's zinc miners. And the odds are that the zinc mining industry is going to struggle to match the growth in demand, and it's going to struggle to offset the closures that are going to happen over the next couple of years. And as a result of this, both in the near and long term, we would expect to see the zinc price significantly higher than what you guys are used to. And on that note, I'll conclude. Thank you.
Thank you. Thank you very much, sir, for updating us about the crossroads for demand and supply for the zinc, or taking an international perspective also. Thank you once again. And yes, moving on, we would now like to deliberate on perspectives on steel, zinc, and galvanizing. And for the same, we are delighted to have amongst us Mr. Abhijit Kulkarni, Associate Principal with McKinsey's Mumbai office. Abhijit is also McKinsey Mumbai's core leader for energy and basic material domain, and primarily serves large mining companies across India, Australia, and Africa. And on that note, let's request Mr. Abhijit Kulkarni to take it on. A very good afternoon, Mr. Kulkarni. Mr. Kulkarni, please.
Good afternoon to all of you. I'll today speak about primarily the steel market, the global and Indian perspective on steel, a few key trends on the zinc market, and finally on galvanizing market in India. Starting with steel, historically, if we see steel demand as globally has risen in three key phases. The first phase was in the 80s to the early 2000s, where the steel demand was increasing at a 1.2% per annum growth rate. Then a sudden surge between 2000 and close to 2010 with 7%, and a moderation in the last 5 years. What we expect is going forward, the base case, the steel demand would grow at about 2.8 to 3% over the next decade or so. Primarily, a lot of this would be driven by the developing regions, and against our normal thought process, China actually over the next couple of years will start tapering, and the demand will come from other developing regions like India and other parts of the world. If you see here for India particularly, I think for the next 7 years, about 7% growth in the demand, and then tapering beyond that to about 2.5%, 3% for the next decade. What is interesting is the steel industry has always seen overcapacity historically, and we expect even going forward, the utilization levels will remain at around 80%. If you particularly see presently, the utilization levels have come down. While we expect them to slightly go up, but there still continues to be overcapacity in the market overall. Coming back to India, we have seen a decade of high growth, almost a 9% increase year on year on steel demand. But over these last 2 years, particularly, the growth has stunted. Between 2011 and 13, now we have about 1 to 3% growth. And the utilization has come down. The capacity utilization particularly has come down from its peak of 90% in 2010 to about 80% now. What's therefore interesting is if you see the cash flows of major steel players. Over these last 3 years, 90% of the steel players in India are showing a negative cash flow. And that has increased particularly in these last 3 years. This is not sustainable for the steel players going forward, and you'll therefore see a change happening. Structurally, what is important, this is what we call as the typical S-curve in terms of what is the steel intensity versus the GDP intensity. If you see China, it has grown to this top, whereas in